Good evening, class, and welcome to our advanced taxation class for today. Today, the topic we'll be taking is taxation of the digital economy. Taxation of the digital economy is a very important topic. And so, these are some of the things we are going to be seeing in this topic. First of all, we'll be looking at taxation of digital economy in Nigeria, then the challenges of taxing digital economy in Nigeria, the challenges of digital economy taxation of uh, then we talk about the OECD and EU experience, tackling the problem associated with taxation of digital economy, other jurisdiction experience, then tackling the problem associated with taxation of digital economy, what's the way forward in Nigeria. Then we see the provisions of the Finance Act 2019 on digital and other services in relation to significant economic presence of a foreign entity. So let's take it one at a time. Digital economy is the worldwide network of economic activities, commercial transactions, and professional interactions that are enabled by information and communication technology called ICT. So when the ICT enables economic activities to occur, a network of all of these commercial transactions. So it could be that you are making a business on the internet. So digital economy is also called the internet economy or the web economy. So ICT has brought the world to become a global village where you can have a professional interaction. For example, this class is being held virtually. You are not in a physical class, you are online. And so the digital economy has made teaching to be done online. You could be buying anything online too, using the World Wide Web or using a third party app that connects to the internet. All these are made possible by digital economy. Increasingly, the digital economy is intertwined with the traditional economy, making a clear delineation harder. And the digital economy is becoming an economy in itself. International borders are closing in and distance is no longer a barrier. So you see people trying to do importation or exportation and with ease. You import things with ease, barrier of international borders are no longer there. You buy things on the internet from Amazon, you are schooling online in the United States, you're in Nigeria schooling in the United States virtually, or in UK virtually, paying the school fees. There is no border distance. You don't have to fly to go there. The elements of the digital economy includes digitalization and intensive use of information and communication technologies. For example, we are having an online class. What are some of the digital information technology tools we are using? We're using the computer, the internet. Most of us are using Zoom. And this video will be translated to us via email. And you'll be watching it by clicking a YouTube link. Okay? Now, even in the class, we are using digital pen to mark and highlight. All these are digital tools. Information and communication technology made that possible. Intensive use. So if there is no intensive use of digital tools, so digital economy will not be possible. And most of all, be ready to use internet connection, data, codification of knowledge, transformation of information into commodities, and new ways of organizing work production. So we see new ways of making our teaching better. Previously, you may be just be, be inclined to just see the teacher's face, but now you are seeing the particular work he's doing. Previously, there was nothing like whiteboards in our classes, but now whiteboards are being introduced. New ways of making teaching more organized and productive. Now, look at the taxation of digital economy in Nigeria. Taxation of digital transactions has become a Herculean task for tax authority all over the world. Why? Because digital transactions require little or no physical presence to the parties to which income accrues in the jurisdiction of the customer. Okay, so now look at it now. Let's look at, for example, you go to school in the United States, maybe you did your master's there, and you didn't leave the country. You are right here in Nigeria taking a lecture or school in the United States. You are paying your school fees there, and when you graduate, you are an alumni of that school. Now, it requires no physical presence. The people in United States do not come to Nigeria to come and lecture you. They send you their bills through the platform or through the email. You pay, and it's difficult to now tax United States, the school in United States that earn income from Nigeria. And so it is usually challenging to determine whether tax on cross-border transactions such as this should be paid to the jurisdiction where value is created. In this instance I use, value is created in the United States where the school is being held. The professor teaching you there is in United States. Value is created there. So it's a challenge to determine whether these school fees we are paying, if the tax should be paid to United States where the value is created, or to Nigeria where this value is being consumed, because the person who is learning this, uh, going to this school is in Nigeria consuming the education. So should they pay to tax to Nigeria or to the United States? Moreover, the general rule for taxing income of foreign ex enterprises in a given jurisdiction is by establishing that the entity is physically present or has a permanent establishment in that country. And so, let's say um, the school in the United States, if they have a physical presence in Nigeria, let's say they have a campus, even if it is online, they have a campus or maybe an office which serves as kind of information gathering, or maybe they have a showroom. Okay, uh, we know that a showroom or an office where they have for gathering just information. even though they are physical structures, they do not become fixed base. When they have an office or so where they raise invoice or where they have lectures, orientations, and all that, it could be said that they are having physical presence. And so they may want to tax the office because of that fixed base. Okay, that is the general thing. So if a foreign income is being earned and there is a fixed base here, or there is an agent here, so you may not have a fixed base, but you have a dependent agent here who is working for you, you will be taxing that school based on the permanent establishment, which we have learned before. So the profits derived from, let's say, Nigeria, uh, is going to be taxed, even though they are sending it down to the other country. So he said that thus profit derived from foreign jurisdiction might end up not being taxed in the jurisdiction of the consumer where money was parted with. So when they have no physical presence, no permanent establishment, so you cannot tax where the money was parted with. Now look at Zoom and YouTube and Facebook, Google. Okay, they don't have physical office in Nigeria, especially say YouTube and Zoom, which is the major things we're using here. YouTube, Zoom. They don't have physical office in Nigeria, but we end up paying for subscription for Zoom. Who tax the income made from Zoom? The only thing that is being taxed here is VAT, because you must pay VAT, that's a vatable service. But the income earned by way of buying the license, that's a revenue. When they declare revenue for their company, who taxes them? Is it Nigeria? Where because Nigeria buy a lot of Zoom license, the ones bought from Nigeria, do they tax their income there, or is it from United States? The same thing with YouTube. You are We are making use of YouTube channel to dispense our videos. Value is even created here. Okay, value is consumed here because the value is created in the people who put the YouTube link or so into place. They have put structures to create value, and we are consuming that, and we are parting money with it. It's not being taxed here. So that's a problem with the digital economy in Nigeria, taxing it. The Organization of Economic Cooperation and Development, also called OECD, and the European Union, EU, have offered certain recommendations to address incidences of non-taxation of income arising from digital transactions. These include the introduction of digital service tax. So, digital service tax is an introduction that when there is a digital service, you need to be taxed for that service. Then there is the concept of virtual permanent establishment to help determine the incidence of permanent establishment for tax purpose. So you may not have a physical permanent establishment, but you may have a virtual permanent establishment. So just imagine if a meeting is being held virtually and it is being done in London or United States, and most of the participants are also in Nigeria. Even if it is one person in Nigeria, that means it's as though there is a virtual presence. Or maybe Nigerians are having a meeting and an important dignitary from abroad wants to be present and he just connected via video conferencing. He has a virtual presence there. And so now the concept of virtual permanent establishment is also for the purpose of taxes. So you see here, someone may have a virtual office. So a virtual office is not a physical office. So you hear people say, I have a virtual office. A virtual office just exists on your phone, on your on your internet. Nigeria seems not to have made significant progress in the taxation of digital transactions. Yes, we are not making progress in the digital transactions. Okay? Although myriads of digital transactions are carried on daily in Nigeria. What are some of these digital transactions carried daily in Nigeria? We have Zoom. For example, just yesterday, yesterday being September 1, 2024, I renewed my Zoom license for 1 year. It will last from September 2024 down to August 2025. It's a digital transaction. Just today, I carried out another digital transaction with another company that will be paying me by just watching videos. So the videos are created abroad. I'll watch them here and I'll be paid. Digital transactions. If I have plenty of viewership on YouTube and I post the videos and I get likes and views, YouTube are going to pay me. These are digital transactions. You are trying to buy, um, what do they call that? Look at the other day I was trying to look at an alternative to um, Microsoft Office because the one I have is not up to date. And I saw that I can download WPS, which is an alternative. Is WPS a Nigerian company? No. And I download it, although it's free, but that is digital transaction. You want to download um what do they call that again? Um Antivirus. You buy an antivirus, you download it, and you start using it. You want to download Chrome, it's a digital transaction, you start using it. Look at your Truecaller, you pay for Truecaller, digital transaction. Some people's email must have been filled up, and so Gmail will say, okay, extend it by buying cloud space, and you pay for it. Look at QuickBooks, you pay for cloud accounting, digital transaction. And so Nigeria are not taxing enough. They have not made significant progress in taxing all these digital transactions. So a lot of these transactions are escaping Nigerian tax net. Although the Nigerian tax authorities are working towards ensuring digitalization of the tax collection process, it is unfortunate that this digitalization has not been extended to cover effective monitoring and collection of taxes from digital transactions. So you see here, we in Nigeria, we are trying to digitalize our tax process in the sense that we have Tax Pro Max, where you will not be paying tax online. You file online, you pay tax online. The Lagos states have their e-tax services where you file online, you pay online. We are making the tax collection process digitalized. That is very good. But now, are we doing enough to monitor digital transactions? Because Most of the things tra- we are we are we are doing is just to collect taxes, most especially from the ones done physical presence, the one that you cannot escape, which is maybe you have a bank transaction, you have a bank account in Nigeria, your company is physically present in Nigeria, or is registered with CAC. Or yeah, so you find out that you may not be able to escape that and all that. But what about those ones that are not registered in Nigeria, but they are doing taxation, uh, digital services? Have they been able to track and monitor all the amount of money that is going away from Nigerians through Facebook, adverts, Instagram, TikTok, Snapchat, YouTube, Zoom? All these are digital transactions that they cannot effectively monitor. So it becomes a challenge. Now look at challenges of taxing digital economy in Nigeria. You see here that the rapid growth in information and communication technology has brought with it boundless opportunities and changes the way we do business. As I mentioned before, we do buying and selling over the mobile phone. Online payment platform are being done here. Now you see, you the students that came to learn in this platform is a digital platform. So we do services, lecturing services. How did you pay? Bank transfer. How did you transfer? Electronically, e-commerce, e-banking, i-banking. So you see here, this is made possible by ICT. We don't have to meet physically for all of this to be done. A lot of the work I do today is based on virtual presence. These days where you want to submit your registration to ICANN, you don't even go to their office. Unlike before when I was doing mine, I had to go to ICANN office to physically submit a copy, and that's all. And it will take you about 3 weeks, 4 weeks before your name is being done because they'll be checking them manually. And even when I did induction, I had to physically go to submit my induction documents with ICANN. But these days now, people can just do it online. You can give your referee will use a digital pen and sign, and you send it to ICANN online. You don't need a physical presence to do all of that. This is the rapid growth in ICT. The e-commerce story in Nigeria started during the early part of the 21st century, and its development has been on the rise steady. This has been re-echoed by the Central Bank of Nigeria's recent implementation of the cashless policy, although it is not being implemented significantly. But you see here that people are using more cashless policy. People are going to the Although we have less people going to the bank now, people are more likely to transfer cash when they go to the market. So these businessmen, they now have OPay account, Palm Pay. You come and you have your card. You can transfer through your card, or you can just transfer from your phone through your phone to the other person. And because of the increasing um, rate of robbery, people no longer carry cash with them. People don't even carry their ATM card with them. Then we just carry just a normal phone that is not even browsing, but can do USSD. And that's all. You go to the internet ATM and you can do your cardless transaction. All you just need is your fingerprint. They'll send you an OTP on your phone, and it doesn't have to be a smartphone. You bring the OTP, put it in, and that's all. If you can make transfers to the other party. This is cashless policy. Whilst there are numerous benefits with e-commerce, there is a paradigm shift from a physical to an invisible business framework with that comes with its challenges. So now we are moving from physical presence to invisible virtual presence. So because I am not physically present, it's a good thing, but has its own challenges. And one of these challenges is tracking transaction, especially for taxation purposes. So Nigerian government have not put in place things to help us track our transactions for taxation purposes. The drive toward non-oil tax revenue and eliminating leakages are not mutually exclusive objects. So eliminating leakages and the drive for non-oil tax, they are parallel lines which can never meet, and one cannot happen conclusively and concurrently with the other. So the process of diversifying the revenue base of the economy can only be further complemented by choices of the federation to make to arrest revenue leakages from digital economy. So for you to go into non-oil taxation, because the oil tax, the oil revenue can be monitored, can be monitored. But if you are going to non-oil revenue, in order to tax them, you first have to block the revenue leakages. So you need to now learn how that economy, digital economy work. How does that business work? How can you block that leakage? For example, what we are doing here in Zoom lecturing, is there a way that the tax authority will know that this is income earned from lecturing services? Is there a way they can monitor and block the leakages if this is not reported? The inability to adequately capture the quantum of attendant direct and indirect taxes payable on e-commerce transaction has left leakages in the system. Okay, so while this is not a problem created by FRS, there's little doubt that a strategic partnership with institutions which provides platforms to consummate such transactions will ensure that the objective of blocking these leakages is achieved at a faster pace. So it means that if there is a platform where we need to know how, okay, now let's look at it this way. If you are buying digital services, say, let's say you're buying Zoom license, now instead of paying to them directly, you now go through a gateway, let's say remitter. It can be done that goes through remitter, paystack, and all these that are licensed or registered, such that the volume of transactions coming or going arising from these platforms can be traced. So that if they categorize this, okay, um, let me see all the transactions in a day today that arise from Zoom. It can be pulled. Okay, this is the total volume of Zoom license purchased. The VAT on them can be calculated, and we know the revenue that they have made for that day. If it can be tracked using this third-party transaction, then that's fine. So there should be a collaboration such that all these leakages will be blocked. In addition, The applicable rules for corporate taxation have failed to effectively capture the realities of a modern economy in a digital, fast-paced transaction world. So our corporate tax, our normal taxation did not capture the fact that we might the situation might change, that we might no longer, be having physical presence. So, when our 1999 constitution was made, even the, the tax act we have, 2004, you see 2004 as amended, 2014 as amended. This did not capture the fact that there could be virtual digital tax. So the modern realities are not being captured in our tax laws. There are also various profitable business models in the digital services that derive income from countries without creating physical presence, like we mentioned. Given that non-resident companies are taxed in Nigeria based on profits derived from Nigeria, that the question as to whether a foreign company is liable to pay income tax in Nigeria is controversial. So you see here, foreign companies, non-resident companies, are usually asked to pay tax from income derived in Nigeria. Now, should they pay tax when they are not physically present? That's the problem. Section 13 of the Company Income Tax Act implies that a non-resident company must have physically performed activities in Nigeria before such a company can be liable to income tax. So where a software company provides online data to a user in Nigeria for a fee, like what they are doing for me here for Zoom, and provides same to 5 million other Nigerians without being physically present, it may be difficult to legally conclude that this company is liable to company's income tax, although the company may have been seen to have derived income from Nigeria. Also, such transaction may elude the tax authority radar, and the transactions will not be fully subjected to VAT if transactions are not deemed to have taken place in Nigeria. So you see here, VAT is an indirect tax which is gotten almost immediately. If the transactions are not seen to be performed in Nigeria because of physical presence tag, then VAT is being escaped. Income tax is being escaped. So the FRS is making effort to ensure that income arising from e-commerce is subjected to tax. And this effort has seemed to yield some results in the aspect of indirect tax as opposed to direct tax. So you see here that FRS made attempts to assess some foreign mobile application transport operators to income tax in Nigeria on the basis that the income for services they provide is derived from Nigeria. So even if there is an absence of physical or fixed base, they still have to find a way to tax those digital companies. To ensure that companies, particularly digital companies, do not escape tax in Nigeria, the FRS often require Nigerian companies to withhold tax on all payments made to non-resident persons, regardless of the non-establishment of tax presence. So they are required to make that withholding tax. So you can see here that it's a challenge. It's a challenge. Now let's look at in a recent Federal High Court judgment in a case between Vodacom Business Nigeria Limited versus FRS. The Federal High Court ruled in favor of the FRS and held that the Nigerian company was required to account for the VAT on such transactions regardless of the fact that the supplier to foreign company did not perform the services in Nigeria. According to the High Court, the services are not expressly exempt from VAT and are thus liable to Nigerian VAT. So that's the reason why when you are buying Zoom now, you will be charged a VAT. So you'll be charged VAT because they are they are required now to pay VAT. Now let's look at the OECD experience and the EU experience when it comes to taxing the digital economy. It is important to note that the tax challenges arising from digital transactions are not peculiar to Nigeria. So let's see, in 2015, the OECD created a framework to tackle international tax avoidance that arise from BEPS, that is base erosion and profit shifting. We talked about that last week in our lecture. One of the actions for the BEPS project is to address the tax challenges of the digital economy. In March 2018, the OECD, in its interim report titled Tax Challenges Arising from Digitalization, described the typical characteristics of digitalized business model to include wide digital footprint with limited or no physical presence, heavy reliance on intangible assets, and high importance of data and user participation. Digital footprint. Digital footprint. They made a mark in Nigeria. Facebook have a digital footprint in Nigeria. It is being used in Nigeria for a wide population. YouTube, TikTok, they have digital footprint but no physical presence. And so the digitalized business, most of their business model is they will not have physical presence, but will have virtual presence, digital footprint. So it's just like saying you're not seeing a giant, but you see a giant footprint that walked past your street, and you'll be wondering, who has this footprint? So that's this. So they all have digital footprint in Nigeria. Everybody have an account with them, and they are having their impact on physical presence. The EU explains the challenges arising from taxation in digital economy as being a disconnect or mismatch between where value is created and where the taxes are paid. Because where value is created, you are supposed to pay taxes for where that value is created, right? But there's another issue. Where this value is consumed, they are also supposed to pay tax there. So should they pay in both places where value is created and where value is consumed? Or who should win? Is it where value is created that the tax should be paid, or where value is consumed that tax should be paid? So there is a disconnect. So most times it will be argued that where value is consumed, that is where it is going to be taxed. So there is a disconnect between where value is created and where the tax are paid. Due to the resultant revenue loss arising from these challenges, various jurisdictions and international associations have sought various means to tackle these challenges to ensure that taxes are paid in the jurisdiction where income is derived. And where is the income derived? It is derived either where value is created or where value is consumed. So let's see. Now, what are the OECD recommended proposals? Now, they offer some general guidance to member countries. And this is in a report which reached a consensus solution in 2019 and 2020 respectively. So following the report, the OECD members have agreed to undertake a coherent and concurrent review of the nexus and profit allocation rules. The nexus and profit allocation rules are fundamental concepts relating to the allocation of taxing rights between jurisdiction and the determination of the relevant share of multinational enterprise profits that will be subject to taxation in the given jurisdiction. But there are different views among the member countries. So the interim report also discusses an interim measure in the form of excise tax on supply of certain e-services within a given jurisdiction that will apply to gross consideration paid for the supply of such services. So you see here, the major thing here is the profit allocation rule. So what's the ratio that should go to where value is created and where value is consumed? All right, let's look at the EU recommended proposal. In March 2018, the European Commission proposed new rules to ensure that digital business activities are taxed in a fair and growth-friendly manner in the European Union. And they made two legislative proposals. One proposal recommends that member states apply an interim tax called digital service tax, which covers the main digital activities that currently escape tax in the EU. Digital tax, service tax, which is interim, is to be levied at 3% on the gross revenue derived from the following categories: online placement of adverts. So if you derive a gross income, they charge you 3% on that. Sales of collected user data and other digital services, and provision of digital platform to facilitate interaction between users. Right, so these are some of the services that are being uh, categorized under digital tax services that require taxation. The DST will be collected by member countries where the users are located and will apply to companies that have an annual total revenue of over 750 million pounds and an annual revenue total of over 50 million from digital activities. So you see here, these three lines or categories of digital services will apply to companies that have a total revenue, gross revenue of over 750 million, out of which a minimum of 50 million should come from digital services. And that's applied up till 1st January, as their proposal, when a final taxation model is to be adopted. Other proposal aims to reform corporate tax by introducing the concept of taxable digital presence, taxable digital presence, or a virtual permanent establishment. This is important. Taxable digital presence or virtual permanent establishment, to ensure that profits are registered and taxed where businesses have significant interaction with users through digital channels. For example, we know that YouTube, Zoom, they have digital presence in Nigeria. They have significant interaction. Look at Facebook, look at TikTok. In a day, now Telegram has also joined. In a day, people use these digital channels and they have their digital presence. A VEP is designed to introduce a taxable nexus for digital business operating within the EU with little or no physical presence. Now, for this to be possible, a VEP in a member state must fulfill one of the criteria here. It exceeds a threshold of £7 million in annual revenue. It has more than 100,000 users in a member state, or over 3,000 business contracts for digital services. So you see, if it fulfills just one of these criteria, just one, then it can be taxable. Now we have the United Kingdom proposal, and the United Kingdom proposal is estimated to have attracted over 28 billion in investment over the past 5 years. As a result, discussion around the taxation of the UK digital economy are ongoing. Okay, so but the UK government opined that the current misalignment between the digital businesses are taxed and where value is created threatens to undermine the fairness, sustainability, and the public acceptability of the corporate tax system. So there is still a misalignment as to who gets the tax, whether it is where the taxes, where the value is created, or where it is being consumed. We also have the Indian recommendation, and let's go now to tackling the challenges associated with taxing the digital economy in Nigeria, which is most important for your exams. Digital economy, as we said, is growing in Nigeria as it is happening in the world, even though the growth in Nigeria is not as rapid as the world, but we can see a marked difference in the sense that in Nigeria, this is called the digital age. Even a small child today know how to use the digital world. All right. Therefore, there is urgent action needed to block tax revenue leakage associated with existing gap in the digital economy. And some of them include reviewing the scope of what we call fixed base. Like we learned in our previous class, when we look at taxation of non-residents, we said they should have a fixed base, and we saw the meaning of fixed base. Although Nigeria, just like India, is neither a member of the OECD or EU, it is important that the scope of fixed base, as it is in Section 30 of CETA, be expanded to ensure that Nigeria digital economy is effectively captured for tax purposes. So it means that when we are defining what a fixed base is, so normally when they bring tax laws, there's also interpretation, definition of terms. So what is a fixed base? They should expand the meaning of fixed base to cover things that will help us to capture the digital economy. The introduction of the digital fixed base in Nigeria will increase tax base. So if you have a digital presence or digital footprint in Nigeria, it could be expanded to say that this person has a fixed base in Nigeria. So it will increase the tax base in Nigeria, thereby sharing the collective tax burden of taxpayers while increasing government revenue. So you see, one of the challenges in taxing the digital economy is the definition of fixed base under Section 13. And we've seen what can be done. Now, adoption of creative approach through innovative tax legislation says it has become expedient for the Nigerian Tax Authority to explore a more creative approach to ensure taxation of the digital economy. So Nigeria will need to take a lesson from other nations that have taken a bold step to tackle the non-taxation of the digital economy, to plug revenue leakage through what they call innovative tax legislation, rather than extending the interpretation of obsolete legislation to cover broad digital transaction, border digital transaction. So they have creative innovations of their digital economy, so that they are not just following the old obsolete law. Like I said before, our Nigerian constitution is in 1999. It has not been reviewed. We have the Tax Act 2004, 2014. Although right now in Nigeria, the tax law is being reviewed. But you see, when they review it, let them adopt in such a way that you will not be to bring cross-border transaction into the tax net in such a way that digital transactions will not escape it. Then we have the automation of the tax administration. Um, as at the time of the writing of this pack, Nigeria adopted the ATAX, which is electronic filing platform. But now Nigeria is using the Tax Pro Max. So in the adoption of the Tax Pro Max, in automating tax administration, it will ensure that starting from registration of taxpayer, filing of tax returns, paying of taxes, audit and investigation are being automated. So it means that if the day you are supposed to pay VAT, which is on or before the 21st day of this, like we are in September, and if you fail to pay your VAT on or before 21st, when it gets to 22nd, the penalty just automatically comes up. All right. Now, look at um, how Tax Promise is now working. After the 21st, the, the, the Tax Promax, okay, from the first of the new month, the Tax Promise enables you to file VAT for the previous month. It enables you to file. And if you have not filed for the previous month, you cannot file for the current month. The same thing with income tax. So you find a way that they have automated it in such a way that it can be tracked. And if you want to pay, the gateways, as I said before, will enable them to know how you are getting paid, how you are paying your tax. And once you pay, you get your receipt immediately. Your tax receipt is gotten immediately. When you click on apply for tax clearance certificate, you get it digitally. All this without the human interference. That is automation of the tax administration. Then we have data handling. Another critical success factor in a digital economy is data handling. Elsewhere, data with something is treated with reverence. That means data is being protected. And if someone wants to get the data of a company or some people, you will be, questioned. What are you getting this data for? What are you doing with it? What Why do you need it? And it is taken as you are protecting, as if you are protecting egg. But Nigeria's data gathering and storage processes are still not fully integrated. So data handling is poor in Nigeria. So it's part of the ways that we are having problems with digital economy. So when data is even not data cannot be relied on, we have data that uh, data integrity is being compromised, data can be tampered with, data can be hacked and all that. So data handling is also a critical factor. Then we have strategic partnership with digital economic service providers, digital economy service provider. This will ensure that the objective of minimizing and reducing leakages, especially from digital economy, is achieved at a faster pace. We said before that the if these digital assets are being paid for through some online gateways that can be tracked, like I said before, Remita is there, Paystack is there. We even have Flutterwave, other companies that are in Nigeria that where Nigeria can go into strategic partnership with them such that you cannot do anything without going through it, then it can be tracked. But what about those people who are okay now? Normally, you have want to um, do an advert on Facebook or with YouTube. You must have a domiciliary account. You have Mastercard. You have all of that. It's a way of tracking. Then we still have what do we have that again? We have now we have things like all these other digital assets, cryptocurrency, yes, cryptocurrency. We have people legislation in Nigeria that is trying to uh, either accept cryptocurrency or not. But people are still doing all of this cryptocurrency, and it is still escaping Nigerian tax. So, but when we have strategic partnership with digital service economy providers, we can have digital transaction leakages blocked at a faster pace. Then we have ratification of multilateral conventions. Multilateral conventions. So these conventions on related treaties to end profit shifting and base erosion. If we have multilateral conventions strengthening the or tightening the hole where this base erosion and profit shifting is usually being done, then we find out that most of these revenue leakages or the abuse of tax law using creative tax avoidance will be reduced. Then we have capacity development. There is a need for capacity development of tax administrators so that they can implement seamless interface with different payment systems available in Nigeria. So, talked about that. Let's look at the provision of Finance Act 2019 on the digital and other services in relation to something called significant economic presence. Now, in Nigeria here, this significant economic presence is the interpretation of the virtual physical presence. The Finance Act 2019 introduced the concept of significant economic presence to expand the scope of Nigerian tax on foreign companies deriving income from their activities, which is not usually being captured in the tax net. We said before Facebook, Zoom, YouTube, TikTok, Telegram, Instagram, all of them are capturing Nigerians' income and they're not being taxed. Consequently, the income tax order 2020 issued by the federal government of Nigeria, which was signed by the Honorable Minister, provided a clarification on what constitutes a significant economic presence for foreign companies. So, um, determination of significant economic presence for digital activity. The order provides that a foreign company shall have a significant presence, economic presence in Nigeria, where one, it derives a gross annual income turnover of 25 million naira or its equivalent in other countries from any combination of the following activities. So looking at all these combinations, once you hit the 25 million naira gross turnover, then you can be said to have significant economic presence. One, streaming or downloading services of digital contents, including movies, videos, music, application, games, ebooks to any persons in Nigeria. I know that I do that a lot. So you can't be having a high internet data. I will not go to internet to go and download ebooks, movies. So if I ask how many movies have you watched? Even my videos that you are watching is also streaming. It's either you stream it or you download. And the thing is this, when you download it, you have it once, so you can even watch it offline. So you are not even giving them much income. But we Nigerians, we like streaming because we have phones. And so we don't want to download. And so each time we want to watch, we stream. And even if you stream for like 3 minutes, 2 minutes, a video of 2 hours, and you stream it for 3 minutes, it counts as a view. You stream it for 5 minutes, 3 minutes, it counts as one view. You go out, you come out again, and you stream for another 5 minutes. It counts as another view, and that is income for them. So that is it. So when you view that your Facebook page, that video you view, that advert you view, just know that you are contributing in creating digital transaction that should be taxed when the gross turnover reach 25 million. The second one is transmission of data collected about Nigerian users which have been generated from such users activities on digital interface using website or mobile application. For example, data generated from users using Facebook, Instagram. You see people wanting to sell you accounts. They will tell you they have 3 million accounts, 3 million user accounts. They've collected data and they are making money and they are selling it to you. Is it not digital transaction? Transmission of data. And so sometimes you'll be wondering, how did this company get your email address? You didn't fill in anything and they are sending you emails. They've gotten your data. That is digital transmission of data, and they are using it in their mobile devices or their website. So when they have generated up to 25 million naira from this activity, it translates to digital significant economic presence. Then we have provision of goods and services other than those in subparagraph 5 of the order, directly or indirectly through digital platform to Nigeria. We talked about buying of antivirus, even your when you are looking at your phone, like those of us who use iPhone, you want to buy apps, you are buying them on your phone, you are buying directly. Even the Zoom license you purchase, although you are a user, you didn't buy yours because you are a client user. But someone who is supposed to host is supposed to get a licensed Zoom platform, and you see, they are also making money. Even you who is downloading it, you just download and it's free, but that download give them money because you click an agreement with them, and it's a contract, and it's kind of, they have money. So but getting that license is an additional cash to them. We also have provision of intermediation services through a digital platform, website, or other online applications that link suppliers and customers in Nigeria. Look at example of Jumia, Gigi, what's this other one again? Um, Car 55 and other ones, where you need to link sellers and customers. So when you go to Jumia to go and buy things, it's not Jumia that have the item. You just look at it and you click and you will see the name of, you can see suppliers. They will tell you ship from abroad and to be ready so and so period. So it's a medium. So you see Alibaba, Amazon, Jumia, all of these are medium. And when they have their gross annual turnover from these transactions, then it has significant economic presence. That's for A part. The B part says uses a Nigerian domain name. For example, if you say things like ican.org.ng. So .ng is a Nigerian domain name. So if you use a domain name that is in Nigeria, you will be subjected to tax in Nigeria, no matter how much your gross annual turnover is. So that foreign school that you want to have, they will never want to use .ng because it will look as if it is Nigeria affiliated. You would see them using .edu. For example, we have Nextford.edu. That's a foreign school in the United States, but it will not have a Nigerian name. So, but if you see anyone like, for example, if you have something like nextford.com.edu, .ng, wow, by using that .ng, you made it look as if it is Nigerian website and you will be taxed. Then we have the C part, has a purposeful and sustained interaction with persons in Nigeria by customizing its digital page or platform to target persons in Nigeria, including reflecting the price or its product in Nigerian currency. So you see here, you see people in their digital transactions, and you are seeing currency in the prices in Nigeria. When you see a price in Nigerian naira, what does that tell you? That it's targeting Nigerians, right? But if you see it in dollars, of course, you may not target, it may also be a target to Nigeria. For example, look at your foreign schools. You are paying with dollars, right? Now, but you can see that they offer that they will just give you a currency exchange rate. So you do the math. If you are paying, let's say, for example, now Nextford University is having their school fees is about $200 a month. And you now see exchange rate $1, let's say to 1,500 naira. Then it means it's been targeted to the Nigerian because it's as good as reflecting the price in Nigerian currency. So that's it. So we have seen the three things here that Nigerian determination of significant economic presence for digital activity has proposed. Now, determination of SAP for technical, professional, management and consultancy services. Now, it says that the order provides that a foreign company providing technical or management or consultancy services shall have a significant economic presence in Nigeria, in any accounting year where it earns any income or receives payment from a person resident in Nigeria of fixed base. So it means that when this significant economic presence definition is being achieved by a management consultant, a professional, let's say, for example, an accountant outside of Nigeria. We can even say QuickBooks accounting provision, and they are providing management or consultancy services where they receive payment from a person resident in Nigeria. That income is taxed. Now let's look at exemption from the SEP. What are some of the exemptions from this SEP? One of them is any foreign company under a multilateral agreement and consensus arrangement to address tax challenges from the digitalization of economy who will be treated under such agreement or arrangement. So if there is a multilateral agreement to exempt them, maybe because they have double taxation agreement, then that is fine. Then any foreign company making any payment where the payment is made to an employee under a contract of employment. So when you are making a contract of employment to a Nigerian, maybe the person is under a foreign employment, maybe you have a virtual, um these days they call it, um how do they call it again, where you are working and you are staying at home. um um I would say virtual employment, or yeah, where you are working from home, but you are working for a foreign company and you are an employee. So you are earning foreign employment, you are supposed to be exempted from income tax because your employment is foreign. Then for teaching in an educational institution or for teaching in an educational institution, so like what we're doing now is teaching, and so we're supposed to be exempted from SEP. So it means that any income I derive from teaching, even if it's up to 25 million, I will be exempted from that definition of SEP. So this is some of the things we have learned from this chapter 14, part 1 of the taxation of digital economy. So we've seen the OECD treatment, the challenges arising from the taxing of digital um economy in Nigeria, the leakages, and what are the proposed way of blocking those leakages. This is chapter 14 of taxation of the digital economy, mainly talking about the problems faced in taxing the digital economy. We now want to go to chapter 31, which is the part 2 of the taxation of the digital economy. What are we going to learn from here? We'll look at the overview of the taxation of the digital economy, which is kind of a review of what we just learned in chapter 14. Look at the mechanism of e-commerce, the impact technology has on tax practice, role of tax administration, new technologies for practice and administration. We are going to look at a whole lot of things there. We are going to the IT base now. All right. So for many years, a good number of accountants have been engaged either in tax practice or tax administration with so many challenges bordering on non-application of information technology to taxes. Available evidence show that many tax practitioners and administrators are facing challenges due to the changing environment, including disruptive technology. For example, when the COVID-19 pandemic came, then professional firms face this pressure much more because how would they be interfacing with their clients? On the other hand, tax administrators were trying to play catch up in development of their technology so that they will still be able to tax these companies even in the COVID period. And so you see taxation changes, especially in Nigeria when COVID came into existence. Now, digital economy, what does it refer to? It is an economy that is based on digital technology. It is sometimes called internet technology, web economy. So there is a global agreement that the current global and national tax frameworks were not designed to tax the digital economics, especially in the pre-COVID era. It is obvious that digital transactions such as from e-commerce, they generate significant revenues for companies and individuals operating in digital space. And one primary reason for a mismatch between what is expected from the tax revenue and the tax jurisdiction is because the number of service providers in the digital space are not captured within the tax net because they don't have identifiable physical presence. So we'll be talking about this thing in chapter 14. So let's talk about some of the things we are going to see here in chapter 31. Business transactions that occur in the internet, we said they are called e-commerce transactions. They include buying and selling of goods and services. So normally when you want to buy goods, you place your order. Let's assume that you are you are trying to buy goods on Jumia. You start browsing, you see what you like. Sometimes you place it on your wish list, but let's assume that you are buying it immediately. You click on it, it enters your cart. Then when you finish all the things, it's just like going to ShopRite and you are picking the items and you're putting it in that basket. That is the cart. When you are done, you go to the counter. So now you now pay. Sometimes in digital transaction, you pay cash on delivery, which means when they deliver it to you, you pay. Then sometimes you pay immediately. Then there's going to be a stock verification. Then if they went to check the stock that you have picked, because this time we are picking them into a digital basket. Unlike when you are putting them in physical basket, you pay immediately. But this is digital basket. They check the stock is not available, they will tell you it's not available. They will arrange for the product to be imported or to be produced or to be brought into the warehouse. If it is available, shipping will be arranged. When shipping is done, the customer collects it, customer verifies it, and if he wants to pay on cash on delivery, he makes a payment. If he has paid already, then and it's not what it likes, is going to start processing returns. Even these days now, before you even open your goods that you got from Jumia, you would have paid. And when you pay, it's not what you want. You have paid them physical cash. They will not even return it to you. You will start processing your return. So this is some of the example of this is the diagram of how digital operation, the e-commerce happen. All right, so we talked about payment gateways. Payment gateways. In most cases, e-commerce transactions involve transacting money. This process is conducted by a piece of software called the payment gateway. The payment gateway presents customers with payment options, accept identification details such as credit card numbers, and authenticate customers using their password, their CVV code, or multiple factors. Sometimes you see them creating OTPs. So you see payment gateway We have Remitter as an example. So they authenticate you when you put in your card details, you put your card number, you put your expiring date, you put your CVV. They check it, yes, this card is authentic. Then you now put your password, you put your password, they check, yes, it's authentic. They will send you a code, which is called the OTP. You put it, you have authenticated it, and they collect the money, you get the alert. And so that's a way of getting money from the e-commerce. Is it tracked? That's another issue. Why e-commerce is the future? E-commerce is the future because business is not good. E-commerce business will always be 24 hours buying and selling. Because here in Nigeria now we are in the, this is night. This is 9:33 in Nigerian time right now. In Canada, 6 hours away. This should be 3:33. So why we'll be having midnight in Nigeria, why we'll even be having way into the night, Nigeria will be sleeping, somebody in Canada is doing business, somebody in China is doing business. So 24 hours buying and selling. So if your platform is 24 hours enabled, like Amazon, you will always be having buying and selling going on even while you sleep. So e-commerce business is going to stay because of that. There is no geographical boundaries. You can be here and be buying something that is in the United States, and you can be here, somebody in the United States will be selling to you. It costs you far less. E-commerce. All right. Low operational cost is what we are talking about. So it costs you to set up your e-commerce system on a very low cost, and you don't need to go to physical offices to collect your cash. All you need to do is the payment gateway. Let's say you are collecting your money through Paystack. All Paystack we need to do is just to be paid a particular percentage of money that you are collecting, and you get your money to you. So sometimes you may not have to give them your let's say you are doing a business, international business, but you don't have a domiciliary account, and maybe you now go through the pay stack and you are using your Nigeria account. All you need to do is agree to, yeah, and all you need to do is agree to them that they are going to collect this amount of money based in Nigeria. So even if they are paying with dollars into the pay stack account, they are going to convert it to you and pay your money. And so it is just low operational cost for you. Then we have streamlined transaction processes. which guarantees speed. So the speed at which people buy things from Alibaba, Jumia, click, 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 click. You don't even need to go and wait for queue to make your payment. Unlike the one you see in ShopRite, physical presence, you will now wait for queue. I saw a physical store where people are trying to buy bread. What's that bread called again? Is it Boku bread? They queue up and they will stay for hours to buy this bread. And to pay, they will still stay hours to stay to pay. But this is speed in the internet. You just click, assuming that they are buying this bread on the internet, you click and maybe it gets delivered to you. It's easy to start and manage the business. Maybe I'll go into this business now because they say it's easy to start and manage. Who will join me? All right. Now, what is the impact of the technology impact on the tax practice and administration? Now, we see that tax practitioners are independent firms that provide tax-related services to their clients. For example, Go Getter Professional Consult is a tax practicing firm, while tax administration refers to government revenue that are mandated to collect taxes on behalf of the government. For example, the Lagos State Internal Revenue, yes, Lagos State Internal Revenue Service. Now, the current role of tax practicing firm. What do tax firms do? They prepare tax record. For example, they prepare income tax record, they prepare VAT record, withholding tax, other tax record. They compute end of year tax liabilities. They file those returns. For example, my firm will be filing a return soon on VAT collected or VAT that are being incurred for the last month. So they collect and file those VAT. They also advise clients on tax matter. They also advise tax and clients on tax matters. Excuse me. So they advise tax clients on tax matters. For example, they can advise, can you go for pioneer legislation? Can you take advantage of this? Can you take advantage of your capital gains tax to roll over? These are some of the advice they advise clients. Then we have compliance with tax legislation. For example, you need to file your VAT on or before, excuse me, on or before 21st of the month. If clients don't know, they will want to make you comply with that so that you don't pay penalty. There are some penalties that are as big as 500,000 and some as small as 50,000. They help in resolving disputes, tax disputes, and they also manage tax audit and tax investigation. These are what tax practicing firm does. Now, what are the elements of tax practice firm? Now, this is another topic which is called one of the topics we did, which is called tax practice management. So there are 4 elements of tax practice, which includes tax compliance. For tax compliance to be done, you have to gather relevant tax information, evaluate and classify this information, filing of tax returns, and representing clients during audit. All this is done to ensure tax compliance. Then we have tax advisory, which includes tax planning and advisory. For example, you plan to take advantage of future transactions. So you can say, okay, we want to reduce your tax liability. We want to reduce VAT liability we pay to government. So we need to deal more with VAT exempt item or VAT zero vatted item. You also need to reduce your tax exposure. So most people expose their tax information to the tax. So sometimes the tax authority will just tell you, bring your bank statement, and some will just bring their bank statement. And the more you with the tax authority, the way to deal with following them is talk less. That doesn't mean you should manipulate figures, but talk less. The less you talk, the less you expose your company to tax. But the more you explain yourself, the more exposed you are. So this tax planning and advisory will be advice on how to reduce your tax exposure. Also, the way you classify your accounts. For example, when you just put miscellaneous, this will be disallowed. And when it is disallowed, it is going to increase your tax. But if you put some of these items, you classify them in such a way that they become allowable expenditures, it reduces your tax liability. Then we have tax litigation. We have help in settling dispute between the tax authority, in the law court, even the tax appeal tribunal. You go and act as a technical witness in court on behalf of clients. You interface when there's a litigation. Then, of course, we have the tax research and intelligence. What about the tax administrators? What are their roles? One, they should register taxpayers. So when you want to register, you go to tax promas and you get registered. They should educate taxpayers. Normally they say ignorance is not an excuse, but ignorance is reduced when there is education. So you see the tax authorities will be giving education, but the problem is, do we listen? We also have them receive tax returns filed by taxpayers. We also have assessing of taxpayers, individual and entities. Then we collect, maintain record for accounting for taxes paid. Then when they have collected, so they register taxpayers, they assess them to tax, they collect their filings, they collect their report, their returns, they collect the taxes. What do they do with the money? They manage it. And if there is any refund, they make provision for returns. They also conduct tax audits and investigation. Sometimes when you are owing them to pay, they enforce tax debt recovery, and they advise on review of tax legislations and regulations. Now, what are the efforts of technology on modern tax administration? Now, with the coming in of the Tax Pro Max, the system has the capacity to handle different types of tax administration, rendering ranging to e-registration. E-registration is one of the ways that you automate your tax system on Tax Pro Max. And so you need to register on, when you register your company and your company gives you your ROC number, you take it to Tax Pro Max. Although Nigerian system have been doing one for over 2 months now, over going to 2 months now, the e-registration has not been completed because of the way Nigerian system works. But the point here is e-registration is available because of technology. Then we have the e-assessment. Previously, like before the COVID, you usually when you want to file VAT for companies, or income tax for companies, you will need to take it to the FIRS offices that is closer to the individual's business. So imagine you have different clients in different parts of Lagos, and in a day you want to submit 10 file or assessment. You will need to go to 10 different offices, and they may be located in different part of town. That's expensive. But now you see with e-assessment, it can be done electronically so that you'll be getting your tax liabilities assessment. Then we have e-payment. You don't need to go to the bank, although there is an option to go to the bank, but I've never gone to the bank. I would rather take the online, especially if you are paying on the last day. Let's say you are doing VAT and you are doing it on the 21st. And if you don't pay that day and you enter 22nd, you will pay penalty. Will I be going to the bank again? No. I will need to do it that day, especially if that is a weekend. So e-payment is there. We also have point of sales, USSD, bank transfer, quick teller, orders, e-filing. Normally you need to file even though you're not paying that day. So e-filing comes with after assessment. You file. Normally you file first, then you are assessed, because we have self-assessment that you do, and normally the tax authority will also assess you and give you additional assessment. They don't need to come to your office to come and give you this additional assessment. They may send it to your mail. Like when I got a mail from the FIRS addressed to my company. E-filing, you need to file your VAT and CIT returns on the Tax Pro Max. We also have the e-tax calculator. For example, you don't know how much your VAT is. All you need to do is put in your sales revenue, remove the ones that are non-vatable. The system calculates what your input tax, what your output tax is. Your system calculates what your input tax is. Your system calculates what the tax payable or refundable is to you. If there's late penalty, the e-tax calculator calculates for you. If you are making payee, is doing payee, the system calculates for you. You don't need to now know how the tax law is calculating it. Although it is important to know the tax law to be able to develop this calculator, but to a non-tax person, just use your e-tax calculator and say, all right, if I'm earning this salary and these are my allowable deductions, how much tax am I supposed to be paying? It calculates for you. Then there's the ETCC. Normally, you would need usually go and collect hard copy of tax clearance certificate, but now it is available online. Then there's e-reporting, e-audit, e-examination, and all of these things can be done without visiting the premises. You can just hold Zoom meeting to have e-reporting, and you can also hold tax audit meetings via video conferencing. New technologies for tax practice and administration. Now, there are two future trends in tax that rest on technology, information technology. One, increasing use of digital technology. Tax professionals will increasingly use sophisticated technologies to enhance their traditional ways of serving clients. So you see here, they are using digital technology. Gone are the days that they will come and start calculate. Even now, some people don't even use Excel. They use automated apps to calculate their tax, to even do reporting. Some people use apps to do reporting, even auditing. People use software like Caseware and all that to do financial reporting and auditing. There's also audit command language that is being used in the audit world. that requires digital technology. Then there's a radical shift in technology. Yeah, technology does not simply streamline and optimize that traditional approach, it actually displaces the work of tax professionals. So sometimes we usually hear that AI will replace accountants, replace tax professionals. This is because there's a radical shift in technologies such that those who are not AI or technologically exposed already will be displaced. And so these are what we call the disruptive technologies. And some of these new disruptive technologies in the tax industry include cloud computing, like what the QuickBooks and Sage is doing. They automate tax computation, even HRO, payee, they automate it. They automate tax return and filing. You can even optimize your or automate your VAT payment. And they even have tax planning and forecasting. With that cloud computing, you can even pay your tax. So all you need to do, instead of consulting a tax consultant, you just get this cloud computing and you pay the cloud computing technology companies. Then we have artificial intelligence and robotics. Even on your WhatsApp, you can also have this facility for AI. Have you seen this thing they called Meta AI? And you want to do something related to Nigerian tax, simply go and ask Meta AI, what is your tax? And you feed it all the information about yourself. You find out that Meta AI will help you calculate your tax. You don't even need a tax practitioner to help you. All you just need is give it the information it wants, and AI and robotics will do that for you. Then there's the blockchain technology. Blockchain has become globally popular through the achievement of digital currency such as Bitcoin. So we have the blockchain technology people use to record their financial and non-financial transaction in an open, secure, and decentralized ledger. Then we have data analytics technology. Now they said data is now the new coins, the new cash, and it's difficult and it's crucial to use data because without data, business decisions cannot be possible. Data is not just numbers and spreadsheets that accountants and tax practitioners have been familiar for years. It is now including unstructured data. Unstructured data are not data that you can put in rows and columns. These are clustered data. These are data that are unsupervised. So sometimes um, data analytics can be seen in all these um, unstructured data can be seen from things like your ATM machine. When you put in your ATM into the machine, there is something that has character recognition that will recognize the characters, recognize you when you put your fingerprint. So fingerprint recognition is part of data, but it's not numbers. Face recognition. All these technologies are helping people, not just when you put your fingerprint. You know, your phone now, it's either you put in your password or you draw a pattern or you put in your fingerprint. This is data analytics, which goes beyond the numbers of structured data. Then we have social media technology. Social media has played a lot of role in the hands of tax practitioners. So social media is being used by tax practitioners and administrators to educate tax information. Go to YouTube, go to Facebook, you will see tax practitioners, tax administration having handles there where they teach all of these. Tax professionals use LinkedIn, Twitter, YouTube to educate people. And so people are learning more from them by themselves using this social media technology. Then we have mobile apps that can help people to do their do their tax computation by themselves. All you need to do is just install, download or install, and you are good. Some people use these mobile apps to generate invoice for customers. Instead of going to go and buy invoice, hard copy invoice, they just register, buy, or take a trial version or a free version. They customize it, and they will just type their invoice, write the invoice things for you, and they send it to your email, and it's good, and you're good to go. So financial data is being captured. For example, we have QuickBooks on mobile, which help you to, have your financial data recorded and captured for you, even while using your mobile phone. So what is the impact of this new technology for tax practice and administration? One, it will yield to customer satisfaction. This is because the overall performance will be improved. There will be an improved overall performance because we are using digital services. You tend to satisfy the customers more than when you are doing the traditional method. Then there's lower cost of compliance. You don't need to the tax authority doesn't need to start chasing people coming to the office physically to come and check their books, to come and see if they are compliant. By the use of digital technology, when you file your self returns assessment, they will check, they will ask you to bring other evidence to confirm, you send it to them, they're able to, check your compliance at a lower cost. And so members of the tax authorities will be able to focus on more valuable activities other than chasing people physically. Then data error is minimized because it is being automated. It is garbage in, garbage out. If you put in the right thing, it gives you the good information. So we want to assume that you are putting in the right thing, and even if you put the wrong thing and you see the mistake, if you correct it, the whole process corrects itself. Unlike when you are using paper and biro and you make a mistake here and you have used calculator to calculate, it means you start cancelling and starting the whole thing all over again. But here, data error is minimized, and there is improved voluntary compliance. So compliance is voluntary when there is digital technology. For tax practicing firm, time saving is important. So the speed and accuracy of data processing. For example, I'm consulting for a company that is not in Lagos, but when I give them my information, and it saves time, it saves stress. After this class, that is one of the things I'm going to be doing, and it saves time, saves stress, cost savings in the long run. I don't need to travel to that place. They don't need to travel to meet me. We do everything, even on WhatsApp. We now focus on higher level jobs that machine cannot handle. So tax practicing firm can leave the machine to do the tax computation, whereas they can now focus on more important things that AI cannot handle, machine cannot handle. Then there's mobility of service, increase capacity to serve multiple clients. So imagine if you are doing everything on the digital platform and you have to file VAT for 30 different customers. Each of these, each of them takes you 5 minutes on the platform, 5 minutes on the platform. 5 times 30 is about 5 times 3 is 150 minutes. This is about 1 hour and so, not up to 2 hours. you would have filed for 30 people. And imagine if each of them is paying you um, as low as say 30,000 every month for just filing VAT for them. 30 people, that is 900,000. So you can imagine you increase your capacity. You want to say, okay, let me increase to 50. You can serve multiple clients because of this digital technology. Now, taxes applicable to technology-based transactions. E-business and e-commerce have become the order of the day across the globe. And some of the examples of e-commerce here includes online shopping. We know online shopping apps like Amazon, Jumia. We have online movies. You go to um, what's it, Netflix, even Telegram now have movies. Go to Netflix, you go and take movies, go to YouTube, you watch movies. Internet banking, of course, we all know that. Online ticketing and reservation, you book things online. Even movies, book online. You book for even you want to take bus, Uber, you book online. You make reservation for hotel online, auction sites, journal subscriptions, online betting and gaming. People do that a lot. Bet Naija, all that. Online betting is not done. One wonders if the players in the digital space such as Google, Apple, Microsoft, Facebook, Jumia, Konga, and so on, if they pay the right tax to the various jurisdictions where these services are consumed. Do they have physical presence in the countries where their services are taken? This is a major question. Generally, income generated from technology-based transactions are not exempted from income taxes. Most of the traditional types of tax such as VAT, withholding tax, company income tax and personal income tax are equally applicable to technology-based transactions. As I said before, if you want to buy Zoom now, you will need to pay VAT. However, due to the problem of no physical presence of most of the digital companies, many countries appear to introduce special taxes based on the concept of economic presence. We've said that in the last class. Okay, technology on their impact on tax. We've talked about cloud technology where tax management software hosted in the cloud are being used. Storage and retrieval of tax data on the cloud. Of course, it requires you to have internet. If there's internet downtime, you cannot access it. And if your subscription is has expired, you can't access it. Even when you want to watch these days now, like we said before, streaming of movies. You have Netflix. If your internet subscription ends or your subscription for Netflix ends, you cannot stream it. Okay, even DSTV or GoTV stream, you can't even do that. Now, access to analyze tax data anytime on any device. For example, you have QuickBooks, you have 5 users, your accountant is using one, the COO is using one, you at your house, they are the owner of the business, and you traveled abroad, you can just sit down in your house and you are seeing your transaction going on. You will be asking, making queries. Why is this like this? Why is it like that? In your device, you are seeing everything. Then we have data analytics technology, the use of statistics power of modern machine to analyze volume of data. Normally, when you want to do audit, they will pick samples and will say, okay, this sample represents the population. But these days, because of data analytics and the power of handling large data, there will be 100% review, 100% instead of taking samples. Then we have artificial intelligence, and robotics. Artificial intelligence able to respond to queries. Sometimes you'll be browsing the internet and you just see one AI will just come up and just say, hi. The AI might even call your name. Please, how can I help you? You type what he wants you to do and it gives you the answer. You may be even be using Facebook or WhatsApp and you want to get some help, they help you. Sometimes, like I thought that maybe um, one of this AI from one of my bank, I just say hi on WhatsApp to the AI. The AI called my name and say, how can I help you? And I asked for my account number and the AI gave it to me. I asked for my balance. The AI gave me my balance. I don't need to go and type to check my balance. And the AI gave it to me. Ask me what I want to do. Chat box, character recognition, voice recognition can be used by artificial intelligence. Then we talked about the social media technology and we talked about the app, mobile app, and the blockchain. Now, why are these firms using this technology? Why are they leveraging on them? Because they want to win more clients. Because it's easier to, you know, win more clients when you can serve them well. And when you are serving them with technology as your leverage, they are more satisfied. And when you are more satisfied, satisfy your clients more, you will win their hearts. You want to retain more clients. When you want to retain more clients, you need to add more value to them. And when you add improved services to them and they are seeing your value, you are going to retain them. There is also cross-selling services where you sell your services to other firms because they cannot do everything and they contract some firms to you, some jobs to you, you provide those services for them, and you are doing a cross-selling services, and you add greater value because you are automating your system with technology, and you can now focus on something higher than what you can delegate to a mere technology. What about some of the challenges of technology? We said one of them is low computer literacy. Many people in their 60s, 50s, because they are old, they don't have computer literacy, their level is low and it is difficult. And some of them own accounting practice. Now, let me give an example of what happened. Just this past Saturday, I was privileged to host a webinar with my platform, and it's a paid webinar. All you need to do is make payments and fill a Google form where you will submit your payment. And do you know that about 15% people says they can't do that? It's difficult. Whereas a lot of people who form the 85 are younger generation that are computer literate. They can use Google Forms, which is simple to follow. But these ones are used to manual. Bring my receipts, show you the receipt. Okay, I've seen your receipt. Oh yeah, but upload it now. Let's have the receipt as evidence. It's a difficult thing. So computer literacy, low level of computer literacy, make them not to be able to fill the Google form. And so we have to design another method in which to accommodate them. We have poor internet facility. For example, you may be having a class like we are doing now, and network will just disconnect because of poor internet. We're happy that it didn't happen much today, but poor internet facility could be a problem. Maybe when the weather is not good and all that. We have cyber threats, hacking, hacking of your internet data. We have ransomware that could also capture your data and put it to ransom. We have high implementation costs. Of course, we know that compliance or sometimes setting up these things could be low. But that time you are implementing it, you're implementing technology. That time you're implementing it is going to be very high. But in the long run, its operational cost is low, but implementation cost is high. Then there's lack of technical know-how. When you don't know how to use the technology, it may not be computer literacy, but technology know-how. Not everybody can operate their phone, can operate every part, every not everybody can even operate their television, no matter how easy it is, because of technical know-how. Then the challenge of data validation, garbage in, garbage out. So you cannot know the integrity of your data because garbage in, garbage out. What are some of the opportunities we have here for tax practitioners? One, it will allow tax professionals to focus on high-level jobs when they serve their clients. They will be more visible to clients because of digital or technology presence. It's not that they are going to be seeing them physically, but visibility to clients digitally will be there. They'll be able to offer personalized services to clients. Then they are also going to adapt to change. Like look at when COVID-19 came, they adapt to change and offer new services, right? Time saving is there and you become more efficient. Cost savings is also there. Mobility of service because geography is not important anymore. Then it now provide new skills to tax practitioners. So some tax practitioners now will now want to learn data analytics so that they can better serve their customers. They will now learn financial modeling and other related courses or skills that will help them to serve their customers. Then we also have enabling opportunity to work collaboratively with anyone from any part of the world. For example, we could have someone from Canada coming to teach you here on this platform, and it doesn't need to come down to Nigeria. It could be a collaborative work, and there is increased tax audit quality because this technology is making the auditors to ask more questions, more especially because they are taking 100% of your sample instead of taking a few samples. They're taking 100% of your data and using them to analyze. So they are able to ask more questions. Now, IT tools for effective tax audit and reporting. Now, this is tax audit. This concerns the tax administration. So the following technological tools are used by tax auditors to facilitate their tax audits. We have email messaging application. So instead of sending you hard copy letters and maybe sending it through DHL and you now sign, they can send the letter to the email. So they will just tell you that, okay, they are doing a desk examination. Please provide the following document, this document, that document, all in form of email. And it's accepted now in the tax law. This is because email messaging now is a technological tool that enables and it's even free. So they don't need to come and pay big. And the funny thing is that during this period, before they start using email messaging, a company could be in the same building, but just because they want to establish the fact that this has been delivered to the either the tax authority or to the company, they will go to the DHL company, and the DHL company will bring it back, bring it to them, and bring evidence of delivery. That is what they need, evidence of delivery. So they may be in the same street, the same, but they will go and pay, go far and go and pay to serve them this letter. But you see, with email application, it is easy to facilitate audit process. Then there's video conferencing, so they may have audit discussions, they may have discussions, pre-audit meeting, exit meeting, reconciliation meetings on Zoom, even WhatsApp. Do you know that even you with your WhatsApp, you can even share screen? And so ever since the COVID pandemic, all of these things are being done. Then we have data analytic and audit tools. Tax auditors can make use of data analytics to collect and analyze data that are financial and non-financial in nature. Big audit firms uh, usually face large amount of data that may take them several weeks to analyze them manually. But with these tools, it will take them just minutes. To take them just minutes. Some of these tools include MS application and Word. Now let me even tell you something now. Like this Google Sheet that I spoke about. Imagine going for a meeting where attendance is required and people must sign in and sign out. And you now have a physical paper. As they come in, they are signing. As they come in, they are signing. As they are leaving, they are signing out. And you want to, you know, because they attended a conference, you want to give them their credit hours or so. You need to start typing them again. Typing them. Imagine there are over 2,000 people that came. It will take you over 2 weeks before you finish typing and give them their credit hours. And you still make mistakes. But imagine now if you have them that even like ICANN induction now, if it was manual, it would take them a lot of time. But now if you ask them to fill a Google form and they sign in when they come, or there's an app where you fill when you want to enter, they will scan your code and check you in. The time of checking in is being registered and you are going out, you clock out, your time of checking out is being done. All these things will ensure that it is your work is done speedily. So all of these things are important. So data analytics, it makes them to analyze the data very, very fast. For example, with the registration method you people use in registering here, I can know who registered when, who paid when, and all that. So all of these things are important in tax audits. Now look at tax management software. Most of the modern integrated tax system, which is ATAX, come along with a module for audit management. And this module, when activated, can be used by tax authority auditors to manage the entire audit process from case selection to issuance of demand notice to the audited entity. So tax management software are important. So here, in this second part of the digital technology, transition of digital economy, we have seen what digital technology can do, can assist the tax practitioner and the tax administration. In part one, we saw the challenges of the government everywhere in the world to tax digital services. And we saw things like introduce digital service tax, and we saw expanding the scope of physical establishment, permanent establishment to include virtual establishment. We've seen significant economic presence here. But now in this part two, we have seen how this uh, digital economy can be used, opportunities exist to help practitioners as well as tax administrators to be efficient and effective in their work. And we've seen the drawbacks, which are mentioned to us as low literacy level, which can be beefed up when you enroll for computer literacy class and you increase your computer awareness. These days, there are digital tools that can help you to improve your digital computer literacy. You can get them from YouTube, Udemy, you can learn all of that. Internet facility is being worked on these days. Now internet, although it is bad, but it can be improved with time. But the cyber threats, hacking, these days we are now told to do um, two-factor sign-in or so, two-factor security, so that you reduce your cyber crime or threat and technical know-how. But of course, the challenge of garbage in, garbage out is on the user itself. So all of these are just some challenges. Some of them are not as critical as collaborating with the digital technology in order to ensure that effective digital services and tax automation is possible in Nigeria. So far so good. We have come to the end of our class, Taxation of the Digital Economy, Part 1 and 2. So in our next class, we'll be taking some core topics. So this is the final month, and so we'll be going into more areas that will become increasingly demanded in the examination. So thank you so much for coming to today's class and having a good time with me. When the video is ready, of course, we'll use our digital tools to ensure that you get this video to you. So thank you once again, and see you in my next class. Do have a wonderful day.